Okay, thank you, Mary, and congratulations again, Stephen. So I'm Allison Schiraldi. I am a member of the board and a career chair for CFAOC. And I'm really delighted to introduce our discussion today, which we've titled The Outlook for the Asset Management Industry. So as we all know, the global asset management industry is experiencing unprecedented change right now. And for those of us who work in the space, we're seeing it every day. Lots of challenges and complexities related to fee pressures, consolidation, technological disruption, regulation, and the list goes on. So today we are joined by Scott Gakowski, hopefully I pronounced his name correctly, and Amanda Walters from Deloitte's CaseyQuirk's practice. So they're going to share with us their fresh ideas, research, and perspectives that really outline today's industry dynamics that are reshaping the industry we all work in. So Scott is a senior manager and leads project engagements for traditional and private market managers on product development strategy and M&A. He also oversees CaseyQuirk's performance intelligence and alternative investment manager benchmarking services and thought leadership. Amanda Walters is a principal and member of Deloitte's investment management and real estate leadership team. So she works with their clients across a number of complex strategy engagements. And she also advises management teams on potential M&A activity and provides support for integration planning. So I will turn it to both Scott and Amanda for their presentation. If you do have questions, feel free to put them in the chat box. We'll also leave some time, around 5 minutes at the end, for any other questions too. So I'll turn it to you both.
Great. Thank you for that introduction, Allison, and pleasure to be here with all of you today. In case anyone's unfamiliar with CaseyQuirk, we've been around the industry for about 20 years now. We originally spun out of Siegel Rogers Casey. We were their manager services division. And from an independence perspective, wanted to establish an independent entity to advise managers on how to look better to investment consultants. The practice has since evolved, grown quite a bit, and now become part of Deloitte. But we like to say that we are the industry's largest consulting practice dedicated exclusively to asset and wealth managers. And so Amanda and I would like to speak with you today about really the state of the industry. We'll go through two sections of the presentation here. The first will be about the market environment broadly. What are some of the structural trends and dynamics that create the opportunity set, as well as a set of challenges that asset managers have to address. And then the second portion, we'll talk about what are the steps that we see successful asset managers taking to really accelerate growth and outperform in this environment. And so with that, I'll turn it over to Amanda to walk through the market opportunity portion of the conversation. The entire thing will take about 30 minutes, and we will open it up for 5 or 10 minutes of questions on the back end. So as Allison suggested, please post any questions in the comment box at any time.
Can you put it in presentation mode?
Yep.
Great. Well, good afternoon, everyone, and thanks for having us here today. As Scott mentioned, first we'll just touch on the financial health of the industry, which is very strong, in fact, despite the last year of COVID. Last year hit new high water marks for the investment management industry, with assets and revenues at all-time highs. Growth in AUM was primarily driven by strong capital markets, and a momentary downturn in March and April in capital markets was sustained by really strong capital appreciation through the end of the year. Revenues, which are highly correlated to market action, also reached their highest number yet, though kind of year-over-year growth was somewhat muted by persistent fee compression, driven both by investor demand for lower cost investment strategies and general allocation shifts to lower fee generating strategies. Operating margins also rebounded throughout 2020 to a median of around 30% or so, driven by the strong revenues that we just talked about and more muted growth in operating expenses. So over the past few years, we've seen persistent increases in expenses over that time period, driven primarily by significant investments in technology spend, just the increased complexity of doing business. But operating expenses last year actually grew a bit slower. Travel and entertainment, as an example, was significantly lower for the last year than it previously was, given the COVID environment. And all of those factors helped support kind of robust operating margins. So it's still a very, very good industry to be a part of. If you flip to the next slide, Scott, when we look at the overall flow environment of the past year or so, despite an initial shock of outflow in Q1 of 2020, net flows quickly rebounded in Q2 and... Oh.
Sorry about that.
Technical difficulties.
Yeah. Here.
Do you want me to try to pull it up?
No. Is this better?
There we go. Yep.
Perfect.
So despite the initial shock that we saw in Q1 of 2020, net flows quickly rebounded in Q2, Q3, and Q4 across all vehicle types, ETFs, mutual funds, SMAs, and pooled and commingled funds. Net inflows by quarter were primarily driven by domestic fixed income, money markets, global fixed income, and passive strategies. Based on some of the initial work that we've done, also looking at kind of Q1 results for this year, the positive net new flow story is continuing into this year. The crisis also created an interesting opportunity for asset managers to differentiate on performance. So while we've seen a relatively steady median excess return figure over the last 5 years, hovering around that 0% or so, Q1 2020 created an opportunity for active managers to significantly outperform, while others on the downside did face declines in performance in the bottom quartile of excess returns. Looking to the future, there are a number of trends across asset class, geography, and channel that are worth calling out, and many of these have been the same or been relatively steady over the past few years. I think first, from an asset class perspective, private markets solutions, multi-asset class solutions, and hedge funds account for a significant amount of future revenue growth when we look out over the next 5 years and our demand projections on where that growth will come from. Traditional equity and fixed income strategies will continue to grow from a revenue standpoint, though at a lower rate. And passive strategies will remain somewhat steady from an overall allocation standpoint, but their revenue growth will continue to tick up over time. From a geographic lens, North America continues to make up about 50% of overall assets under management, and organic growth will continue in the US. But if you look at the overall net new flows by geography, overwhelmingly, we envision that will be driven by APAC and specifically through mainland China over the next 5 years. And then lastly, from a channel perspective, there has been a pretty big shift in terms of how asset managers are facing off with different channels. And the shift has been towards more of this new institutional landscape, away from kind of legacy defined benefit plans, given the decline in defined benefit plans, and more towards defined contribution, retail intermediaries, and individual investors. Two other kind of trends, I think, that were accelerated by the pandemic that we wanted to touch on here as well. One is namely that the virtual meeting environment will likely continue going forward. Through a recent study that we conduct of large asset owners, we uncovered that many investors believe the virtual hybrid environment will persist. And whether that's kind of external meetings with strategic partners, doing manager due diligence, training, it doesn't appear that we'll be going back to the old ways of working based on what the large asset owners are envisioning for their own futures. The two notable areas where more face-to-face is expected is in internal planning meetings and board meetings, perhaps no surprise there. Scott and I actually held a session yesterday with a group of investment manager CFOs on the topic, and many are really grappling with this issue right now in terms of what's the right model going forward. I think the majority of firms believe that some sort of hybrid model will be the way of the future, but the details around what that will look like are still being ironed out. So for some, it's really at the functional level of thinking through, are there certain roles like investment research, investment ops, fund admin, M&A as examples where some form of in-person work will be required versus others where perhaps having a more virtual engagement model will be just as effective. I think a lot of the other managers were also grappling with just the notion of, if we agree that some sort of hybrid model is the way of the future, what does that actually look like? So how many days in the office, which days, are Mondays and Fridays off limits as an example? Should everyone come in on the same days? And to be honest, I think not many folks have figured out the answer yet. So lots of task forces are put together to try and tackle this question. A lot of executive leadership time and bandwidth is being spent on it. But I think there's still a lot being worked through for asset managers as they determine what that future workforce model looks like. The second trend that we probably saw accelerate a bit during COVID was an increased focus on ESG. So many asset owners anticipate that if they look at their own portfolios, there'll be more ESG integrated over the next few years, which has a number of implications for the asset managers themselves in terms of defining a number of key questions, I think. So what does the asset manager actually stand for? What's the ESG vision that they want to put out to the market? And what processes and tools will actually help them enable that vision? And then how can the organization ensure that their approach is credible and authentic? So a lot being worked through both in terms of virtual environment and ESG dynamics for the asset management industry. And Scott, I'll pass it over to you to cover off the next section.
Great. Thanks for that, Amanda. And the next section, as we said at the beginning, is more so about what steps are managers taking, what are they investing in order to be successful moving forward in today's environment. And on the left-hand side, we make the point that really success in asset management over the long term is generally a result of successful organic growth. And organic growth actually tends to be the metric that is most closely correlated over time towards enterprise value. So a lot like every other sector practically over the last 5 or 10 years, as a value manager would be keen to tell you, there has been a valuation premium attributed to the firms that are able to grow quite consistently. And in our benchmarking work that Amanda and I lead, we often make the point that, look, you can't cost cut your way to long-term earnings growth in asset management. It's really about driving growth, driving, effective client relationships, and figuring out how best to navigate volatile markets and win more and more assets. When we think about the firms that are truly successful, we do see 5 major areas or characteristics of the firms that we see winning. The first is a clear competitive advantage in investing. Increasingly, a part of that story is the approach to ESG. for a lot of managers. We also see a lot of investment being placed behind distribution. So we touched on virtual engagement a bit from the asset owner perspective a moment ago. But as asset owners become more familiar with, apps on their smartphone, they like more and more, sophisticated and self-directed analysis of investment opportunities that requires a new way to engage relative to kind of, the wholesalers of 15 years ago or so. Technology is disrupting investment management all the way from investment decision-making through to just efficiency and scalability of the overall enterprise. And then M&A is an increasing part of the narrative in the industry. So we'll quickly touch on some of the approaches managers are taking to differentiating along these lines. So the first and probably most fundamental, most important characteristic of a successful manager is a really robust investment value proposition. And the exhibit that we have on the left-hand side of the page here actually comes out of a paper that we wrote on reinventing active equity, where we did an analysis of really long-term performance of various asset managers, looked how that translated to growth. And we did find that while it's a minority of strategies that do outperform on a consistent long-term basis, we do find that those strategies represent a surprisingly large portion of overall industry AUM, which is to say that investors have, to some extent, been able to find their way to quality. And we do find that performance is being scrutinized in more sophisticated ways than it has been in the past with the advent of all types of factor betas and factor-driven approaches. And active managers really have to be able to be not just S&P 500, but explain the investment characteristics of the products that they're offering in more sophisticated ways. And we really find that it's a smaller set of liquid equity and fixed income products that are successfully outperforming and telling that story. And really performance is table stakes to growth. And so what do we see managers doing in order to turbocharge and accelerate that growth? We see one kind of leveraging and harvesting as much scale, profitable scale as you can get in your flagship core strategies. We also see a lot of attention being paid to ESG. So development of a house philosophy around ESG. We've seen more and more convergence of public and private. So quite a few managers have bolted on private credit strategies, private equity strategies, given that there aren't quite the same amount of substitute products as there are in the liquid space. Fee pressure tends to be a bit less robust. And so we do see some migration there, as well as vice versa, as the Blackstones of the world start to get into more liquid offerings. There has been a bit of, over the last few years, rotation into quant, as well as a lot of growth in more outcome-oriented strategies. So rather than just pure excess returns relative to a benchmark, thinking through how to help an investor achieve their outcomes, which you can see in the growth of LDI strategies, growth of target date, as well as the models that are becoming increasingly prevalent in US retail. So we see managers investing in these product development areas. Sustainable investing is a particularly interesting area because there's a few different ways to play it. I think there's very clear demand tailwinds, but managers have to make decisions around what is their approach to ESG or sustainability across the entire platform. So to what extent are ESG frameworks and processes going to be adopted across all investment teams? And how can you authentically tell a credible story to the marketplace around what you believe and how you apply that through your investment process? And so we see both the development of new, specifically sustainable products, as well as kind of the incorporation of sustainability perspectives into existing strategies. And so on the left-hand side of the page here, we show growth that will come from strategy conversions. These are strategies that are not currently marketed as sustainable products that will adapt sustainable norms and practices within the product. And then we have organic growth coming out of newer products as well that will drive quite a bit of growth in addition. Another key area, and we've talked about this kind of in a variety of contexts, is just technology. And here we see firms at very different places of their technology journey. So we see the vast majority of the industry probably in the transforming bucket here, which is they're starting to realize that technology is an important trend in the industry. They're taking steps to invest in new types of data, enhanced dashboards, perhaps for their portfolio managers, their analysts, but they don't really feel that they've gotten it right yet. And there aren't all that many firms that will stand up and tell you that they feel that they have a leading kind of array of investment technology or back office technology for that matter. There are a few firms who will tell you that. We would classify those as the front runners. And what we find in those firms is that they have been able to generate faster growth than their competitors, but they don't necessarily spend more. So if you look at the tech spend percent of total cost, it's only about 12% in the front runners relative to 12.5% for the transforming firms. However, if you look at how they're spending that money, a much greater portion of it is being spent on the dark blue bar here, which is innovation rather than business as usual type of spend. So they're piloting new teams, new partnerships, and really trying to innovate in ways that are aligned to your value proposition rather than modernizing, old back office systems that really aren't going to move the needle in terms of the value that you're bringing to your investors. Distribution is another area where we're seeing quite a bit of evolution across the sales process in terms of the adoption of technology. I think a lot of the latent potential and a lot of the time that's being spent is particularly on marketing and prospecting. So you can see on the right-hand side of the page, the high priority for integrating technology, the marketing content distribution, the prospect segmentation. Everyone's trying to take a page out of Facebook's book and be able to both aggregate data relative to who's reading what pieces of thought leadership. You're basically trying to develop a client profile of what does this investor care about, and how can we best market to them. And so we really see a lot of marketing technology being tied into a CRM, and that whole distribution architecture can be quite effective in yielding enhanced ROI from your marketing efforts. We see a little bit, I would say, a little bit more historic evolution in the servicing space, where we've seen firms get a bit better about onboarding, about client reporting and sales management, those latter portions of really servicing rather than winning business. There's been a bit more time spent there. Firms feel they're a bit closer to where they want to be, although certainly see a lot of room for improvement. But the idea here is effectively to be able to leverage technology to allow asset owners to consume reporting data, performance data on kind of an as-needed basis, and to do that as efficiently as possible with technology and service providers. And then lastly, it's hard to talk about the industry these days sometimes without talking about M&A and some of the larger deals that have happened. As we talk about the increasing challenges garnering inflows into traditional active strategies, where really it's the cream of the crop that's able to continue to grow at a fast pace, and there's a large portion of products that are less competitive in the industry. That creates one catalyst for this. When you talk about all of the growth opportunities that we mentioned in private markets and ESG and technology, that creates a catalyst to buy. And it also creates a need for investment that some firms view as important just from a scale perspective. So being large enough to make the investments that you want to make in developing market-leading technology, the infrastructure, et cetera. And I think we would say that we've seen quite a bit of M&A activity across all four of the fronts that we provide here on the page. So internal business unit integration, this you think of as some of the multi-affiliates in the industry taking a look at all of their holdings and realizing that, okay, we have 12 asset management subsidiaries. They all have fairly consistent, or they have complementary return profiles. Can we get leverage out of a centralized distribution force? Can we start to create scale benefits by leveraging service providers or a common operating platform across those? And are there investment benefits, whether it's deal sourcing on the private market side, or whether it's kind of creating decision support for PMs, perhaps? You know, what support can we provide from the center that we can scale across? That's one area where we've seen quite a bit of movement in the multi-affiliates, as well as, I would say, in bank and insurance-owned companies. Bolt-ons, this is really about growth. I think we've seen a good bit of investment here as well. This is the classic example of kind of filling gaps in your product roster or in your distribution market presence through acquisition. and then the third category, there's probably fewer examples. So scale oriented, you might say Janus Henderson, you could say Aberdeen Standard Life. This is really the idea that we want to be one of the larger players in the industry in order to both realize economies of scale and often have a broader and more diverse array of return profiles to offer to their investors and be able to draw on the diversity of those components to create multi-asset solutions for pension clients as well as individuals. So scale for scale's sake. And then the last is transformative M&A, which is more vertical integration. The Amundi deal a few years back, which comes kind of packaged with structural distribution, for example. The Athene merger with Apollo, we would put in this category where it's really kind of reshaping the traditional asset management to intermediary to end investor relationship. And so we touched on a lot of different topics there at a fairly high level. Happy to go deep in any of the areas that were raised, but would be great to get any questions from the group.
If nobody is willing to offer the first question, I would love to. And for those of us who are on the line that are in more of a distribution role, very curious kind of what your perceptions are of how you mentioned that we're likely to go towards a more virtual world going forward. So what are how will distribution roles evolve aligned with that expectation?
Yeah, I think one area that firms are thinking about there is what is the balance of basically adding more hybrid wholesalers and thinking about kind of the balance of internals and externals, as well as biding time a little bit. I think similar to the virtual environment where firms are taking a hybrid approach to going back to the office. In some ways, I think the clients will really set the direction of travel in terms of their own preferences for engagement. And so we see the firms that we work with really trying to deepen in the relationships with their existing clients, understand what they want, and making sure that they're catering to their core audiences in the most effective way. Oftentimes that means, there's always going to be a lot of in-person engagement that's part of the story. But at a minimum, that will be supplemented by a pretty robust data and technology offering that provides clients and prospects the information they want when they want it, and puts you in the best possible light.
Yeah, I would just add two quick things on that. I think we actually saw kind of productivity of distribution professionals this past year skyrocket. And so for the most part, it challenged the notion that you actually have to be in person to make significant sales. And so I think a lot of firms are just grappling with what's the right number of days that you have to be in person versus how much you can do from a more virtual or mobile environment. And I'm not sure there's a clear answer yet on that, but I do agree with Scott that it will be much more of a hybrid than kind of fully pushing back everyone into the field, particularly on the retail side. I think the second point I'd add is it's also calling into question just what is the right virtual engagement model. So, we're on a Zoom today. I don't know about you guys, but Scott and I are on back-to-back Zooms all day long, which can get somewhat exhausting and fatiguing. And I think clients are starting to feel that way too. So a lot of asset managers are now asking the question of, is there a different way to engage virtually beyond just kind of these interactions over Zoom or Teams or WebEx, and trying to get creative on One example I've heard for example was a salesperson actually kind of riding on a Peloton class with one of their clients and then meeting up afterwards for virtual coffee. So trying to get creative in the ways that those relationships are built if you can't do it in person through either a meeting or lunch or dinner.
Hopefully they let their client win. No, that makes a lot of sense. Definitely resonates with I'm sure the group when we think about being back to back and how efficient we can be when we're not on planes and trains and automobiles to reach our clients in remote locations. So I appreciate that a lot. I want to make sure others have a chance to ask a question.
Yeah, hi, this is Mary. I do have a question. I was interested in the area of adopters of technology. And I was just wondering if you could kind of talk about who are the leaders in adopting technology to support investment decision making, and what types of investments are they making?
It's a really good question. And as I said, there aren't too many firms who will be too public about it. I think there are a few notable more quantitative and technology focused hedge funds that I would point to is kind of the 0.72s Rentex of the world that tend to be particularly strong on this. And I think we see them investing in a number of areas. One is kind of alternative data, so new types of data that perhaps they haven't been looking at in the past that they can bake in to their investment process and have an edge just because they have information that others don't have. We've also heard conversely that you're kind of adding more confusing things into an already complicated puzzle. And so other managers have directed more of their attention, more so on the attribution front, thinking through not just at the fund level, but for each individual, say, buy or sell recommendation, kind of trying to structure and model out what are the decision points or recommendations made at what period of time. Was that the right call or not in terms of kind of did our predictions come to pass? And if not, kind of what was the reason that we were unsuccessful? In trying to look into oftentimes even things like behavioral biases in the way that the PMs think. That will be unveiled through some of these technologies and decision support areas.
I think it's also through just new hiring of specific skill sets for people that have kind of a data and analytics background. So we actually recently had a polling question in one of our sessions with CEOs that asked, what are the biggest process changes related to technology that you're implementing to accelerate development? And 100% of the CEOs that responded, I think it was a group of 30 plus, all said they were making investments and new hires in data and analytics. And so it's both the, buying the actual data itself or finding alternative sources of that data, but also making sure that you have the right skill sets on the team to actually analyze and leverage that data and skill set effectively.
Yep. A lot of central technology groups are being established, and I think managers are starting to embed those new skill sets and resources more so into their existing processes, into the actual desks themselves, so that they make sure that they're not just building technology for technology's sake, but rather building something that's quite specific to the investment process that addresses a need or a gap that the teams already feel.
Hi, this is Barry. Just wanted to ask a couple of kind of structure vehicle related questions. One around mutual fund to ETF conversion and kind of future of product from that standpoint. And then also around the use, looking at fees and fulcrum fees, being able to have more performance-based metrics for those active managers and active funds out there, and kind of what you're seeing from a trend standpoint.
Yeah, so I would first say on the mutual fund ETF conversion, I certainly think we've seen a significant trend there for the last 10 years that we expect to continue. I think there is room for active managers to capitalize. Certainly there's been quite a bit of buzz around ARK Invest in the last year and what they've been able to do in active, non-transparent. So I do think that we see firms looking at that space, and we see opportunities there. And active ETFs more broadly are, in one sense, an opportunity to perhaps offer more attractive fees without cannibalizing your existing book of business or repricing the existing book. So I think we'll continue to see growth on that front. I think SMAs and model delivered SMAs are another big growth area that we saw with Aperio getting bought, and then right after that, or I think Eaton Vance and Parametric went first, and then it was Aperio. But we see quite a bit of growth there too, as investors look to provide tax advantages. And then on the second question on fulcrum fees, I think that would be challenging in the retail space in a 40 Act format. We haven't seen too many managers have success with it. We've seen a lot of firms experiment with it on the institutional side, where there's a lot more flexibility to discount at the point of sale, and more mandates are sold kind of at some discount to a 40 Act rack rate. With that said, there can be operational challenges with it on the asset owner side, for example. So it's more complex for the asset owner to kind of track what fees they owe and understand kind of the performance stream. And often we've heard managers say, we tried it, and our asset owners kind of get that if we shoot the lights out, we're really kind of taking upside off the table with performance-based fees generally. I don't know that comment applies to fulcrum fees specifically, but those would be my initial thoughts.
Any final questions? Well, thank you both for the insights that you shared with us today. I think that our president, Mary Siegler, has a few kind of concluding comments that we'll turn it back to her. But again, really appreciate all the insights. And I believe there was a question mark in the chat around, will that presentation be available for our group after this is over? Please let us know if that's something that you're willing to distribute. We can take it offline too.
Yeah, happy to do that. And we'll send those over. But thank you for having us today. Really appreciate the time.
We really appreciate having you both here today. And it was a great presentation, a lot of good information. And thank you so much for that. It's nice to meet both of you.
Nice to meet you as well.
Likewise. Thanks, Mary. Thanks, Allison. Thanks, everyone.
Bye.